Hi, my name is Alka Aneja, and I'm from On Track Realty, and you're here with Irash Shimoni from NJ Lenders. Iraz, welcome back.
Thank you. Thank you. Glad to be here.
Thank you. Iraz, we're talking today about down payment. A lot of people come to us and say, "Can we put less than 20% down?" What happens to the mortgage insurance? Are townhomes, do they need more down payment than single family homes?
Okay.
So, can you talk a little bit about that?
Yes. Okay. So there's a big misconception that today you still need 20% down, which is far from the truth.
Okay.
A first-time home buyer can put as little as 3% down.
Okay.
Okay, that is the minimum down payment. And the general rule is if you're putting less than 20% down, you would have to pay mortgage insurance.
That's right. It's called PMI.
PMI,
Right.
exactly. So when it comes to a single family home and you put, let's say, 3 to 5% down,
Mhm.
mortgage insurance is always required, but as a lender, I like to give your buyer a few options.
Okay.
Your traditional is monthly mortgage insurance.
Mhm.
Your second option is if they pay it upfront, mortgage insurance is like a one-time fee, which eliminates the monthly one.
Okay.
It saves them money, so there's almost like a discount on it.
So, how does that work? Talk to me
So
about
basically, I'm going to make up numbers here.
Okay.
On a $300,000 loan amount, let's just say the monthly mortgage insurance was $150 a month.
that. Okay.
The one-time insurance may cost you $4,500 as a one-time fee.
Oh, okay.
So you have to do the math to say how many years will I have that monthly insurance,
Right.
and which way comes out to more money.
Okay.
Traditionally, if someone says to me, I'm going to aggressively prepay every month towards principal to
Mhm.
reach 20%,
Mhm.
monthly insurance is the way to go.
Okay.
If a customer says, look, I'm probably not going to make extra payments, the one-time insurance is fantastic because not only is their monthly payment less per month,
Right.
they save money.
Right.
And if you're putting down 7% or more, you could actually finance that one-time insurance. You don't have to actually come to
Oh.
closing with it.
Oh, okay. Because
Okay.
I was just gonna say that if they don't have money to put money down, they're not gonna have money to give you the money up
Right,
front.
right. So sometimes the customer say, well, I'm going to put 8% down. So I'll say, why don't you put, let's say, 6% down and use that 2% to pay for the mortgage insurance?
Got it.
Okay, but you could still finance it.
Got it.
And then there's one other way, which is probably the least popular way, is it's called lender paid mortgage insurance, where we bump up your interest rate and you don't pay it at all.
Oh.
So that would be the least of my favorite options, but I will show the customer 2 or 3 options to have them understand that even though they're paying mortgage insurance, it's not the end of the world. I mean, I always
Yeah.
tell people, a lot of consumers unfortunately think it's a penalty. And I always tell them, look,
Well,
it's convenient,
Exactly.
right? If
It's
you want to have
convenience.
more money in the bank, you could put less money down,
yeah.
pay the mortgage insurance, or pay as a one-time fee, but you have more money. So you're
Right.
willing to pay a little bit more per month to have more money in the bank. So
That's
I like
right.
to show them their options, especially when they say, I don't have 20% down.
Yeah, and I think that's where an educated lender comes into play, right? Because you can give them more options than just you want to put down 5%. Okay, that's fine. You can show them how to work the system, so to speak, and make it the best fit for the consumer.
So look, a lot of lenders don't do that, unfortunately.
Yeah.
So when I speak to, let's say, your customer, and they say, I want to put 10% down,
Yeah.
I'll show them a couple of options, and they'll come back to say to me, well, no one else told me about these options exist.
Exactly.
So it's my job to show them there's more than one option.
I actually didn't know about the money up front option.
Okay, so there you go. You
there's
learned
something
something
that
new.
I didn't even, yeah, I didn't know that either.
Yes,
So, yeah.
and by the way, sometimes it could also help for people to qualify. So if you're too tight on your qualifying,
Mhm.
if you eliminate the monthly and you pay the one time,
Right,
it can
then
help
that-
you qualify. And that's why it's so important to be strategic and for me to understand what your buyer situation is, how much they make, do they have good credit, what are their goals, and I can try and come up with an option that no one ever thought of.
That's
right?
awesome. Now, speaking of credit, does credit affect interest rate?
Yeah, so credit score, the minimum score today is a 620 credit score for a conventional loan.
Okay.
The way it works is to get the best rate possible, you need to have above a 740.
Of a 740.
Okay, anything below a 740, you will pay more money per month.
Got
Okay,
it.
so there's 700 to 720, 720 to 740. So if you're under 700, it can definitely get more expensive.
Got it. Okay.
Also, the mortgage insurance is also affected. So your monthly
Oh.
premium and your upfront premium,
It's effective.
it's affected. Your monthly fee and your one-time fee is also based on your credit score.
Oh, that I didn't know.
Yes, so the better
Oh,
credit you
okay.
have, the less you will pay in mortgage insurance.
Oh. And when does that get waived? So let's say somebody's working hard to pay it off. When does it automatically get waived, or do they have to come do another appraisal, or what happens?
Okay, so at 22% equity,
Right.
if the customer never prepays that extra payments
Okay.
to reach 20% equity or 22% equity, by law, the mortgage insurance drops off if you take the monthly.
Got it.
At 20%, you could call the lender and ask them to remove the PMI.
Okay.
Now, if you accelerate the payments and you paid it down so quickly, like in 1 or 2 years, the lender may make you pay for an appraisal at worst case scenario, and then you can drop the PMI much sooner.
Got it.
If you're taking a one-time mortgage insurance premium, then there's nothing to get rid of because you
That's
paid
right.
it up front.
Yeah, you paid up front.
So the rates definitely is associated with your actual credit score.
Right.
Now you did ask me about condos, right?
Right.
With down
Yes.
payment? Okay.
Yes.
So another big topic. Your customer has to realize when you buy a condo
Yes.
with less than 25% down,
Okay.
the interest rates are a little bit higher.
Okay.
Now, if someone says I'm buying a townhouse, but it's still a condo ownership where
Right.
you only own the inner walls,
Yeah.
it's treated as a condo.
That's right.
And that applies to a 30-year amortization or a 20-year loan. But if your customer says I want a 15-year loan, the down payment doesn't matter and the rate's the same.
Oh.
So there's less risk to a person taking a 15-year loan. And if you can afford it, great. If not, it's not the end of the world. But consumers have to realize that a condo ownership does cost a little bit more. Not a lot, but the rates are a little bit different.
And are the rates higher? You have to put more money down, I understand. That you have to put down 25%. But are the rates higher?
The rates are higher if you're putting less than 25% down.
The rates are higher if you're putting less than
Right. So
25%.
specifically for a
Okay.
condo, if you put less than 25% down, your
Okay.
interest rate will be a little bit higher
Okay.
on a 30-year and a 20-year.
But at 25% down, your rates are
The same.
Same.
Right. So
Okay.
at 25% condo down payment,
okay.
it's the same rate as if someone says I'm putting 10% on a single family.
Got it.
So 25%, again, a lot of times that customer doesn't have that 25%.
Okay.
And I just explained to them that it's just going to cost you a little bit more per month, but nothing crazy.
Nothing crazy. Okay, great.
Yeah.
Thank you. This was very valuable. I learned stuff, so I
I'm
can
so
imagine.
happy.
Yeah,
Okay,
thank you so
great.
much. Thank you for sharing with
You're
us, guys. I
welcome.
appreciate it. Thank you. So we've given you a lot of information today, and if there's anything that we can clear up for you, or if you have any questions, feel free to give us a call. We're here for you, and we're here to make this process seamless for you. Thank you for trusting us with your biggest purchase.